The fixed interest rate mortgage cliff. Is this the thing that's going to crash the property market? Well, in today's episode, I'm going to look at exactly what is this fixed interest rate mortgage cliff that is dominating so much of the headlines and what it means for property prices going forwards. The argument is that lots of homeowners took advantage of record low fixed interest rates in the roughly 16-month period between September 2020 and December 2021. And now those record low fixed rates are expiring, and there's going to be this tidal wave of homeowners who can't afford their mortgages, who are going to default on their home loans. They're going to fire sell their properties, and it's going to crash the market. Because after all, as I record this, we've just had our 9th straight interest rate rise. And so the argument is that many of these mortgage holders won't be able to afford their mortgages now that rates have risen so much compared to the rate they were on, and they're going to crash the market. Now, whether that argument makes perfect sense to you or whether it sounds a little iffy, stay with me because I want to share actual data and numbers with you so that you can make an informed decision. Firstly, if we look at this chart, we can see that from late 2020, 4-year fixed rate mortgages dropped below the variable rate. And so many mortgage holders chose to fix their mortgages. Now, prior to this, 16% of mortgages were fixed. But when fixed rate mortgages dropped below the variable, according to the Australian Bureau of Statistics, this rose to between 33% and 47% of all mortgages. And we can see that in this chart here when we look at a fixed versus variable new home lending in Australia. What you can see is that the percentage of loans from variable was quite high up until January 2020. Then it started to drop. Why? Because fixed rate mortgages started to increase, okay? And we can see that fixed rate mortgages increased from late 2020 until the end of 2021. But it never crossed 50%. So if you look at this chart, it's clear there was never a time when there were more fixed rate mortgages taken out than variable rate mortgages taken out. And that's quite different to what's been happening in other countries, okay? But now look at what's happened since the end of 2021. Fixed rate mortgages have dropped now to their lowest in recent times. So most loans now are back on variable rates. So the scary headlines about this mortgage cliff situation is referring really to loans taken out during the 16-month period between September 2020 and December 2021. But the question is, how many home loans were actually taken out during that period of time? According to the Australian Bureau of Statistics, during this 16-month period in question, again September 2020 to December 2021, 799,000 owner-occupied mortgages were taken out in total. Now, this includes first home buyers, it includes home upgraders, people taking out construction loans, and refinances as well, okay? Now, mind you, refinances were the majority, okay? Refinances were anywhere between 55% and 82% of all mortgages taken out during the 16-month period. Now, we can't get an exact figure due to the different time lags in how the ABS data is reported, but we can get a range. So let's just focus on the lower end of the range. Let's say that over half of all mortgages taken out during the 16-month period in question were refinances, not new home loans. So I'm not looking at the 82% figure, I'm saying it's only 55%, okay, which is still more than half. But then that makes sense, doesn't it? I mean, if you're a mortgage holder, if you have a loan on your home and you can get a low rate on your mortgage, why wouldn't you? It doesn't mean that you're in financial trouble. It actually means that you're being financially smart. And I just don't think the media and the headlines give enough credit to the average mortgage holder in Australia who will do almost anything they can to get the lowest rate they can on their home loan and then pay off their home loan as soon as possible. All right, so we have the situation here where we have 799,000 mortgages taken out in total, 55% were refinances, 45% were new mortgages. And it's the new mortgages that's in question when people are talking about this fixed rate cliff. So if we take 799,000, multiply it by 45%, we end up with 359,550 new home loans written during this period in time. Let's round up. Let's make it 360,000 just to keep the numbers easier. Okay? Now, remember what I said earlier on about the percentage of loans that were then fixed? It was anywhere from 33% to 47%, okay? Much higher than the normal average 16%. But does that mean that everyone who fixed their loans are now in financial difficulty? No, not at all. In fact, many people have actually started to refinance their loans. According to the Australian Bureau of Statistics, refinances are at record highs. If we look at this graph from the Australian Bureau of Statistics, which talks about the external refinancing values in Australia, what you can see is that total refinancing is at an all-time high. And this is as of December 2022. So by this stage, we'd had 8 interest rate rises. And so for most people, that meant a reduction in their borrowing capacity of 30% or upwards. And yet, many people were able to refinance their home loans. But back to our mortgage cliff. As I said, 360,000 new mortgages written during this so-called danger period, and anywhere from 33% to 47% were fixed. Now, considering the data from the Australian Bureau of Statistics, which shows that refinances are at record highs, I'm going to use the lower figure in this range for my calculations. So I'm going to stick within this record high range, but I'm going to stick to the lower figure of 33%. So if we take 360,000 new mortgages multiplied by 33%, that gives us 120,000 new mortgages that could be at risk from this fixed interest rate mortgage cliff. And you can bet that the media will be able to find 1 or 2 out of that 120,000 mortgage holders who do end up in financial difficulty, and they'll put them into the headlines. And then they will say that based on these 1 or 2 examples, the rest of Australia is also in financial difficulty, or the majority of the rest of Australia, shall we say. It makes a very emotionally compelling case. But as property investors, we don't want to make decisions based on emotions. We want to look at data, because data and numbers don't lie. So let's get back to our numbers. Remember, we have currently 120,000 mortgage holders who could be at risk of financial difficulty. Now, let's say that unfortunately half of them, I don't think it'll be that high, but let's say half of them end up struggling to pay their mortgage, potentially being at risk of defaulting. We're down to 60,000 households, 60,000 mortgage owners in financial difficulty. Still a very big number. But consider this. We have roughly 10 million households in Australia. And of that 10 million, 6 million have mortgages on them. So therefore, if 60,000 mortgage holders run into difficulty, it's 60,000 divided by 10 million homes, which is 0.6%. But okay, if you want to say, okay, well, no, that's not fair. You've got to compare it with mortgage holders. Okay, let's say 60,000 mortgage holders run into difficulty out of the 6 million mortgages that we have in the country. That's roughly 1% of all mortgage holders. But is that a big number? How does that compare with normal risk levels for mortgage holders? Well, here's what the ANZ CEO had to say. And this article is from February of 2023. And the article goes on to say, ANZ has 1 million home loan customers, and those who had just shifted from a low fixed rate to a variable rate were in better shape on repayment levels than the average home loan customer, he said. So according to ANZ CEO, most people who were on those ultra low fixed rate mortgages are actually in better position than people who weren't. This immediately then has to cast doubt on the argument about whether this fixed rate mortgage cliff actually even exists. And if you think about it, doesn't it make sense? I mean, if you've got homeowners who've been on record low interest rates and they've had extra surplus money that they've now put into savings and offset accounts and paying down extra on their mortgage where possible, and then when they refinance, they're of course going to be so much further ahead on their mortgage than people who did not take advantage of the ultra low fixed rates that were available. The article then goes on to say, Mr. Elliott said that across ANZ's home loan book, a measure of who was behind on regular repayments for the past 90 days was at its lowest point ever. The historical average was about 1% of households being behind in repayments on the 90-day measure, and that increased to 1.5% in the early stages of the COVID-19 pandemic. But it was now below 1%. It's the lowest it's ever been, Mr. Elliott said. Households are in much better shape than people think. So remember, he says the historical average of people being behind on their home loans or at risk of defaulting is 1%. And we just went through the numbers and worked out that there are potentially 60,000 mortgage holders who are at risk of going from ultra low fixed rates to the current higher rates and struggling to pay off their mortgage. But when we look at that as a percentage of total mortgages in Australia, that's also 1%. So it seems like then the number of people who might be in financial difficulty, it's only in line with the long-term historical average. And if that's the case, how can it crash the market? And I bet if you were to drill down into the suburbs where most of these mortgage holders who are at risk live, you'll find that the majority of them are in pockets around Sydney, Melbourne, and even Canberra. But as property investors, these are suburbs you'd probably want to avoid anyway. So put simply, people saying that the mortgage cliff will kill the market are probably the same ones who told you back in 2021 that when JobSeeker and JobKeeper ended, well, that would kill the market, right? Remember those sort of headlines? Well, we know that when those two government schemes ended, it had zero impact on the market. In fact, prices rose steeply. Now, of course, I am not saying that prices are going to rise that steeply again, but there's no doubt that the mortgage cliff is really a lot of media hype, and there isn't a lot of data to back it up. But here's what's really interesting. Most property buyers, most property investors will not do this level of research. They're simply going to read the headlines, believe the headlines, and then stand on the sidelines, are taking a wait-and-see approach, waiting to see what's going to happen as a result of this mortgage cliff. But as you can see from the data, it's going to have very little downward impact on the market, if any. And as a property investor, this gives you a massive window of opportunity to get in the market now, while so many other buyers are fearful and taking a wait-and-see approach. But also sellers are fearful because of the headlines, and that makes them more negotiable. And that's something you cannot afford to forget, because it really seems like for the savvy property investor, there is an opportunity in the first half of 2023 to get a great deal on a property right now and then ride the wave of capital growth that is coming. Now, I'll talk more about that future capital growth in another episode. So if you want to find out more, make sure you like this video and subscribe to my channel. But ultimately, I hope this has helped you dispel any doubts about the mortgage cliff. It's not something I'm concerned about at all. In fact, I'm looking to aggressively grow my portfolio in the first half of 2023, following these very same principles that I am talking about. I hope this helps. See you next time. Hi, it's Nero here again, and thanks so much for watching. If you like what you saw and you're looking for a proven recipe, a blueprint on how to build a property portfolio that gives you passive income, then click the link below this video and get a copy of my book, Wake Up Wealthier, How to Build a Property Portfolio that pays you an income each and every month. Okay, when you click the link and you download your book, you can get both the digital version and the audio version in case you don't like reading. All right, so I used to sell this book for $49, but right now I'm making it totally free. Why? Because I want more people to get this information, and I know that a segment of you will then like what you see in the book and choose to reach out to find out more about our services. But even if you don't, if you're serious about building a property portfolio that pays your passive income, then you really want to get my book, Wake Up Wealthier. It contains the secrets that I have fine-tuned over the last 19 years. It's totally free for a limited time. Click the link below.